My name is Michael Guyett, publisher of the Lead Lag Report, and our special guest for the hour is Ben Hunt. So, Ben, I appreciate that you're doing this. For those who are not familiar with your background, your research, set the stage as far as who you are and what you tend to focus on.
Sure. Well, I've done a lot of different things. My wife says it's hard for me to keep a job. But, I'm a defrocked academic, meaning I got my PhD 30-something years ago at Harvard, and I was a political scientist of all oxymorons for 10 years. Tenured spot, but like a lot of your listeners, I had the entrepreneurial bug. And if you suffer from this, it is a bug, not a feature. You can't help yourself. So I left a tenured spot and to start a software company and sold that company, or sold my interest in that company, and then started doing some investing. I really liked the game of investing, both on the private side and then starting in 2005 with public equities and credit, long short fund. So I've been in markets since then, since 2005. The hedge fund, we got up to about $1 billion. I had a career year in 2008. And then in 2009, it's like you went to the wall and flipped a switch on our returns. We never lost money for our clients, and I'm really proud of that. But single-digit returns and running a hedge fund, that just doesn't cut it. So gave all the money back to clients in 2012. Again, something my wife still hasn't forgiven me for, and decided to try to figure out why a fundamental approach to investing didn't work anymore. And that's when I started writing Epsilon Theory. The name Epsilon Theory is from the epsilon term in the basic econometric formula of alpha and beta. That's the source of your returns, right? But in all these econometric formulas, there's another term that's always tacked on the end, which is epsilon. Epsilon for error, the things we don't know, the things that we ascribe to randomness and to chance. And my belief, and this is the thread that winds through academia, the software company, the investing, is that what exists within that epsilon or error term is not just random or stochastic, that there are patterns and signals that come from our social interactions. And in particular, I'm talking about the way in which we humans are hardwired, and I mean this literally and in a biological sense, hardwired to respond to stories and to story arcs, that we look for stories to explain everything that we do, whether that's politics, sports, certainly investing. That's what I mean by narrative. And so for the last decade, I've been focused exclusively on understanding stories, the way we tell the same stories over and over again, the structure of those stories, the grammatical units of those stories, and how that can be a signal for investing. 4 years ago, I started a company with my partner, Rusty Gwynn, and that's all we do. We do our fundamental research on narratives and how it impacts markets, and then we write about it through the blog and the website Epsilon Theory. So that's the quick and dirty, Michael. It's been a professional career trying to understand narratives, not in the sense of sentiment, which is that way I think most people think of narratives, are using nice words or mean words to talk about something. No, what I mean by narrative is a story arc, a script, the language we use to tell ourselves these same stories over and over and over again about all sorts of different things, and how that can be identified, it can be measured, both for the creation and the spread of these narratives, and then how that can inform our investing.
Okay, so there's a lot I want to talk about, which relates to some things in my own career. So going to the hedge fund, having that great 2008 and then kind of mediocre-ish 2009, and then eventually giving back the money to clients.
Yeah.
It's always when you're in the investment business, not the business of investing, the investing business, I always find it's very hard to distinguish whether you're selling the low or if it's sunk cost fallacy. So what I mean by this is, let's say you have some strategy which you believe is going to work. You launch it, you start raising money for it, and the cycle, the moment you launch it, just doesn't want to favor it.
Right.
So you're underperforming, you're lagging, your assets are not coming in. People are saying you suck, right? But it's one of those things where you end up needing the assets to survive the drawdown long enough to ultimately come back, but you don't know if you should close the firm down, or if you close the firm down or the strategy down, that's the moment that the strategy turns and the business turns.
Sure.
So I'm curious about following your closing on and giving back that money. Was there anything in the last several years that made you think, well, maybe I shouldn't have done that, or maybe if I held on a little bit longer, it would have had a turnaround? Because I think it's a very interesting thing to think through. That unless you're in the business, you don't really feel or understand.
Yeah, no, I feel just the opposite. I feel like, thank God I gave the money back before I started losing money for clients. I say that it's like John Elway, right? I mean, when do you retire? You retire when you win the Super Bowl, right? You retire before you start going down on that long decline. And the reason I feel that way is that what our strategy was based on, which was fundamental analysis, trying to look for catalysts for when your fundamental analysis would pay off. That it's not that stopped working, right? Fundamentals still matter, right? So value investing, growth investing, all the things we're taught and we're told and we're trained to do, it still works. It just doesn't matter, right? What I mean by that is that it's not that you're doing something wrong. It's not that you got stupid in '09. It's not that your cash flow analysis and thinking about management teams and thinking about what this earnings report is going to be and the like. It's not that stuff is not true. It's that it doesn't matter for price. And the reason I believe it doesn't matter for price is that there have been 3 secular changes in the world. And by secular, I mean it's not cyclical. This doesn't go away. It's not mean reverting. There have been 3 secular changes in our world. They started well before the great financial crisis, but the events of '09 really kicked it into high gear. And those 3 secular events I'm describing are, 1, the development of always on, not just social media, but media, period. Right? It's the development of 24/7 quote unquote news channels, which of course there's not enough news to fill 24/7 of programming. And here I'm talking about politics and markets. So what replaces it? What do you fill the time with? You fill the time with opinion presented as news. Opinion presented as news. I like to call it fiat news. It's not fake news. It's fiat news. It's an opinion. It's an idea of how to see the world. It's someone shaking their finger at you and telling you how to see the world. And we are inundated with this. It has become the water in which we swim, not just in terms of, like say, social media, but I think even more importantly in terms of the CNN, Fox, MSNBCs on the political side, and the Bloombergs and the CNBCs on the market side. That's 1. 2 has been that we have developed devices. I call them dopamine machines, like the iPhone that I'm talking to you on right now, that we have willingly addicted ourselves to, that we carry around with us all the time. It's the last thing I look at when I go to bed, and it's the first thing I look at in the morning. So we've created these little machines that broadcast these messages to us, these opinions described as news to us all the time. We're never away from it. And then 3rd, and this is what really got the boost in March of 2009, is that everyone is in on the act, meaning that every central banker, every CEO, every politician certainly, every public health official, everyone understands now that the way to succeed in any social environment is to create a story and to describe it in a way that achieves your goals, right? It's, how do you succeed as a CEO today? It's not by getting another turn of operational leverage on or squeezing more out of your supply chain. The way you get ahead today is creating a narrative that gives you a better multiple on your stock. And CEOs that haven't recognized that are the CEOs that are, they're out of a job, right? That are replaced. So it's those 3 factors, I think, that have been real secular changes, meaning that you can't unring these bells. You can't undo these secular changes in the world. But they've created a world where what matters, what you get paid on as an investor, is your understanding of the narrative and your understanding of the way these narratives are created and they spread within crowds. So a long-winded answer there to your very good question. Yeah, so it kind of depends on the investor group that you're going for. I mean, if you're going to deal with institutional investors, and that's what we all want, right? Then you've got to be true to what you say you're going to do. You can't change your stripes. You can't. You have to be a tiger, not a tiger cub, right? You have to be a tiger that doesn't change his or her stripes. That's critical. What my lesson learned, because I'm sure you experienced this too, Dan, but running a hedge fund, running a discretionary hedge fund, it ages you in dog years. Right? It does. I have no doubt. So anytime you're dealing with OPM, other people's money,
Yep.
It ages you in dog years. And that is particularly true if you're going to be managing on a discretionary basis. So that the only, the crazy thing is, so we're going to get back into the asset management game. And the only thing that makes that even halfway palatable is two things. First is it's going to be a systematic strategy, right? I can't live in a way that requires me to wake up at 3 a.m. with a knot in my stomach because I've got to check what's going on in Europe. I just can't live that way anymore with that sort of with the discretionary approach, because I am convinced that what does work can't be done in a discretionary fashion. Right? I don't think there is more juice to be squeezed out of the fundamental analysis discretionary investor approach. So that leads to my second part, which is the only way that makes it palatable is to focus on where I think there are, I'll use $10 word here, orthogonal returns available. And that's to understand better this world of narrative in the way that we, human beings, see the world, the way we perceive the world. Those are the two things that make it palatable for me to get back to managing money, is do it on a systematic basis, on something that I believe there's actually more juice to be squeezed out of that orange, instead of being one of the tens of thousands of other people who are trying to squeeze a little more juice out of that fundamental analysis orange. Let me say one more thing, Dan, because I think it's a false difference we often make between being an investor and being a trader, right? And I think probably a lot of people who are listening to this call see themselves more as traders than as investors. And what I'm describing about squeezing more juice out of the orange is frankly what I think a good trader has internalized. What do I mean by that? What I mean is that a trader is not necessarily, right, poring over, like you and I did, poring over the earnings transcripts and, knowing your companies and talking to management and blah, 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 blah. A trader's looking at what's coming across the tape. I know there's no tape anymore, but I'll call it a tape. Piece of news comes across the tape. And the trader has to decide, all right, do I fade that piece of information or do I press it? That's what a trader does. 100,000 times a day, piece of information, do I fade it or do I press it? So what I think that most effective traders do is that they've got some inchoate notion of what I'm describing when I say story arc or script or narrative structure. What they're saying is, did this piece of news, what I've kind of experienced as a story that rolls through markets, or does it not fit the story? So what I'm describing in terms of the strategy here, the systematic strategy, is to externalize what I think, effective traders for, hundreds of years have internalized. New piece of information comes across, do I press it or do I fade it? Right? So it's for me, it's a tactical strategy, not a long-term thing, because the life cycle of these narratives, these story arcs that I'm describing, it's 15 days to 30 day, maybe 45 days on the outside, script or cycle. And so I think maybe that's kind of, again, talking about what kind of strategy would I want to run again? It's a strategy like that, right? It's not something that, I'm putting my money in with this company for the next 3 years. It's, no, I think I've got some edge on understanding what this story arc is for the next 30 days. Yeah, so let me give you an example of what I mean by story arc, right? So the example I like to use is from TV and movies. So every movie you've seen, every single one, every movie that Hollywood has put out for the last 30 or 40 years, has followed a 3-act structure. And you can do a quick Google search on 3-act structures on movies. And I don't care if it's a horror movie, I don't care if it's a rom-com, serious drama, comedy, doesn't matter, right? They all follow the same 3-act structure where different events occur at different, you're 25% into the movie, there is the twist, right? You're 75% in the movie, there is the revelation. And it is weirdly, it was Alfred Hitchcock that first, I saw coin this word, talked about the MacGuffin. A MacGuffin is simply the object of desire. And so there's going to be a MacGuffin in every movie. Yeah, it could be a person as the object of desire if it's a rom-com, right? It could be, a heist movie. It's whatever it is you're going to grab. The Maltese Falcon. That's the MacGuffin. But every movie you've ever seen is going to follow a specific structure, and it's going to have items like a MacGuffin. That's true because It works. It works. My point is that there are similar scripts and story arcs and structures for saying, oh, I'm bullish on XYZ, whether XYZ is a single stock, whether XYZ is a country, whether XYZ is a sector. There's a similar narrative arc by saying, oh, I think this is expensive, or oh, I think this is cheap, or oh, the Fed should be hawkish today. There are identifiable life cycles to each of those narratives that I just described. There are a finite number of those narratives that I just described. And where you are in the life cycle of that narrative can give you a real edge in thinking about what is price action in whatever the XYZ we're talking about, over the next time period here.
I want to go back, Ben, the epsilon term, because what you deem as error, I often deem as luck, whether it's good or bad, right? And I always use this point. I forget who said it, but I once saw some equation: success equals talent plus obsession. But what was missing was plus error, and error can be good or bad, right? Positive or negative, right? So, and if you view error as the role of luck, the challenge for investors is that the reality is nobody knows how much of their return profile, good or bad, is because of that error, right? Because it's hard to really properly define it. Obviously, if you're doing well, you'll say that's based on talent and obsession. If you're doing poorly, you'll say it's based on error, bad luck. So from a narrative perspective, how do you think about the way people frame luck in terms of what's happening around them, right? Because to your point, the mind wants to find a reason for something to happen, but luck can be random. Luck can have certain patterns, but it's still something that's outside of our control.
Yeah. So I'll give you a specific example. So from last week, in fact, right? So I think it was last week. Maybe it was the week before. No, I think it was last week. So I guess maybe early in the week, you had a couple of banks come out and give some good reports. I think J.P. Morgan had a pretty good earnings report. Certainly Morgan Stanley, Goldman Sachs did, and all the bank stocks, all the financials went up on that news, right, on those reports. Those specific companies went up more than others, of course, but the whole sector went up. And then as the week went on, I think B of A had kind of a so-so report. Forgive me if I get the names wrong here, but it is like it always is. It's a little bit of a mixed bag. But it didn't really matter, right? Because when those first few reports came in and they were good and the stocks went up, it didn't matter why those individual stocks had gone up. It really didn't. Right? And if you go back and you look at the reports, they're all for very idiosyncratic reasons. The reason that J.P. Morgan had a good quarter wasn't the same reason that Goldman Sachs had a good quarter. But what came out of that price movement was an explanation for why. Kramer, right? He can be my whipping boy for a lot of this stuff, deservedly so. But he starts talking about, oh my God, I'm blown away by the banks, this week. And then he tells you why, XYZ. Pretty soon that gets picked up, right? So you've got a couple of people on Bloomberg talking about their explanation for why the banks are doing well. And then you'll see it on your morning email from Bloomberg by the end of the week. This is why we're bullish on banks. My point, right, is that this is the creation of a story in reaction to a price movement. More likely than not, it has no real relation to why the initial banks went up, right? But it doesn't matter. It doesn't matter, whether it's correct, whether it's right. What matters is how much that narrative spreads. So in that early stage of the life cycle, you want to go with that narrative. But I'll tell you this too. By the time it gets to your morning email from Bloomberg, your kind of market preview, hey, everybody's bullish on the banks for XYZ reasons, that's exactly the point where you want to fade it. That's exactly the point where you want to start fading it. So, what you would have ascribed to your position, if you had been long the banks going into this, you wouldn't have said it's luck. You would have said, no, I knew my companies and I knew that, they were going to have a good quarter. And then, what Kramer said, XYZ, yeah, I did. That's right. That's why they went up. And it wasn't. It's we have this attribution for a why. And my point is that if you track our creation and then the spread of the why, that can give you a real edge. It's a way of, I'll use a poker term, playing the player instead of playing the cards. Everyone thinks they can play the cards the fundamentals. We have everyone looking at the same cards and trying to play the same cards. My point here is that a source of alpha is playing the player. Well, let me start with that about being the antagonist or protagonist first. So there's absolutely an effort by the Fed. This goes back to Bernanke and communication policy forward. It's the whole idea of forward guidance, right? It's to create investor behavior in the direction that you want by using your words to try to change investor behavior. That is what forward guidance is, right? It's using your words not as an accurate description, perhaps, of what you actually think, but choosing your words intentionally to spur or spark some sort of investor behavior that you desire. Right? That is what forward guidance is all about. So forward guidance is a perfect example of what I'm describing when I say that these story arcs and the language and the linguistic structures are very intentionally chosen. It is not an accident that in 2009, what you would hear all the time was this phrase that Bernanke popularized of green shoots, basically a second derivative notion of how to look at how you should be seeing the real economy. It's not that things weren't getting worse, they were, but that things were getting worse at a slower rate. Green shoots, a second derivative argument. And so the Fed, the Fed governors, they say everyone's in on the act, and they are absolutely trying to create investor behaviors through the very conscious and deliberate choice of their words and following a specific script, right? That's the protagonist vision, and that's something we can measure and we can talk about. There's also an antagonist, or also not so much an antagonist vision, but looking at all the other financial media. What do market missionaries, whether it's somebody writing an article in the journal, whether it's somebody, a talking head on CNBC, whether it's Mohammed El-Arian, right, doing something for Bloomberg Opinion. These are all examples of what I mean by missionaries. What do they say? What are the words and the story arcs they're using for what the Fed should do? Right? There's a difference. There's a difference between somebody coming on and describing what the Fed is doing, and then they'll use the words and the language of the Fed governors. There's a difference between that and somebody coming on and saying what the Fed should do, prescribing what appropriate central bank behavior should be. What we actually find, and this is going to be true for my academic research going back 35 years ago, is that the prescriptive story arcs are actually more impactful, more informative as a signal for what markets are going to do than the descriptive aspects. Sometimes they're totally aligned, that both the Fed and the Fed governors will be saying this is what we should do, and other market missionaries are saying, yes, that's what the Fed should be doing. Sometimes they're not. So it's not as simple as there is this antagonist-protagonist distinction. So I just wanted to describe that there. And what we're actually seeing in the data right now is that there is a marriage of the Fed saying we're going to be hawkish and other market missionaries saying the Fed should be hawkish. That combo, that ain't good for risk assets. It's not good for risk assets. Now, that could change tomorrow, or it could change next week. These things change, not really daily, but like I say, the life cycle of these story arcs, they don't stay that way forever. They ebb and they flow. They're born, they live, and they die off to be replaced by another narrative. But on the narrative cycle, the life cycle narrative we're on right now, everybody's saying that the Fed should and is being hawkish. That's not good for risk assets. That wasn't the same. It wasn't true when we were looking at the narrative in, I call it early March through the rest of March. The narrative there was, all right, the Fed, they may be hawkish, but they've got our backs. They're doing this to support risk assets. And sure enough, that's when you saw that really sharp rally in markets after the Fed meeting and press conference, second week, wasn't it, in March? I listened to that presser that Powell had in mid-March, and I thought it was terrible, right? In terms of the body language and the hemming and the hawing, and it didn't matter. We had what we call a Fed put narrative in place, where all the missionaries were saying, it's good for the Fed to be hawkish. Whatever it is they're doing because they're going to support markets. Anyway, I'm trying to give you a little bit of a flavor of the kind of different story arcs we look at. What I'm telling you right now is that the current story arc right here is not good for risk assets. Absolutely. That's very true. No. That's exactly the kind of stuff we look at. It really is. And now I want to kind of emphasize here this sort of narrative analysis. The thing it doesn't do is it doesn't predict very well, right? It doesn't predict new events. It doesn't predict shocks. It doesn't predict any of that. What it can do, though, is it can react really quickly. It's reactive rather than predictive. It's tactical rather than strategic.
Oh, but it can also, Ben, it can also result in scapegoating, right? So I've heard you use that term before, kind of weaponizing narratives, and I've heard over the last month and a half or so different things that are being weaponized in today's environment: weaponized food, weaponized commodity, whatever it be, right? Okay, weaponized money, like as Jim Bianco would say. So, but it seems to me that this weaponization of narrative is resulting in passing on the blame to some other variable, right? So, it's not a political statement, but I was chuckling a little bit under this narrative that, well, it's the Putin price hike,
the Putin price hike,
the war, right? So, but let's talk about that, because I think that's important, because it does result in a lack of responsibility when it's so easy to flip a narrative, the spin room, right, from that perspective.
Yeah, I'm going to make a distinction here between what we call micro narratives and macro narratives. And it's going to be exactly the same distinction that you would make when you talk about microeconomics versus macroeconomics. So if you remember your college classes, micro is you're studying the processes that underpin kind of every economic interaction, the generic economic principles at work on any sort of economic transaction. Macro, on the other hand, is talking about, well, here's a specific principle at work when you're talking about, this national economy versus that national economy, right? Microeconomics, macroeconomics. We see the same thing in narratives. There are micro narratives, and I gave you 4 of them, right? Something is cheap, something is expensive, I'm bullish on something, or I'm bearish on something. Those are micro narratives. We use those narrative stories and story arcs to talk about anything and everything. Macro narratives would be things like the Fed should be hawkish. The Fed should be dovish. We are entering we're exiting a recession and going into recovery, green shoots, right? Those are examples of macro narrative. The reason making this distinction is important is because the strategy we're trying to develop, we call it narrative ARB, not stat ARB, but narrative ARB. And the key, insight of this is that you want to fade micro narratives once they're established, but you want to press macro narratives. What does that mean? It means, in the description I was using earlier, by the time, we're bullish on the banks, Kramer says buy the banks, by the time you're reading that, it's time to fade it. It's absolutely time to fade it. On the flip side, though, when a missionary, like a president of the United States, like the chair of the Federal Reserve, when they say something, and yes, it's going to be for scapegoating, yes, it's going to be for political advantage, and yet they are doing that to try to move price. Price change creates micro narrative, which is why I want to fade it. Macro narrative creates price change, which is why I want to press it. That's the core insight of narrative ARB, right? Is to see the world in terms of narratives, micro and macro, understand that there's a life cycle for all of these, and you want to be on the right side of these because there's a causality between these narratives and price. But it differs whether you're talking about micro narratives, like Kramer saying buy the banks, or macro narratives where it's Powell saying, yeah, we're going to hike and we're going to reduce the global demand function, i.e., we're going to make prices go down. So, I get it when you say, narrative is used as scapegoating. That is the purpose of these macro narratives. You want to ascribe credit or blame to something in a way that is politically better for you, the missionary, to describe it that way. As an investor, though, particularly one who, might be responsible for other people's money, I don't care, right? I mean, that is the way of the world. It bothers me no end as a citizen, and I try to, distance my own mind and heart of heart and frankly vote from that. But, in terms of thinking about how to make money from it, I think you press those scapegoating actions, even though it makes you kind of sick. That is the way of the world. And look, my role in my was primarily on the short side. I mean, I ran the short book because that's the way I'm wired. I see flaws in things, and it's just who I am, right? And what I learned though on the as a short seller, and maybe this has some application to the company you're describing, the analysts do matter, but they maybe not in quite the way you think. I'm going to use Salesforce.com as my example here because, I was running my fund. I was perennially short CRM. I was perennially short Salesforce.com. And I would listen to Mark Benioff come on and give the earnings report every quarter. And I'd say to myself, oh my God, I'm going to make so much freaking money on my short position. Oh my God. Do you hear what the guy's saying? I mean, again, there are no profits in this company. There never will be profits in this company. This is hilarious. I'm going to, every day, right? Or every, 4 times a year, I'd go into earnings and say, all right, wow, I'm going to kill it tomorrow morning. And then this has been true for the last 12 years. So 4 times a year, Benioff will go on to Kramer, and Kramer will hear the spiel. Pro forma net revenue growth. That's the metric. Right? I still to this day have no idea what the hell that means. Pro forma net revenue growth, right? That's the metric by which Benioff wants the company to be judged because he has complete control over that. You can sell profitless software and hit those numbers, particularly if you do. Anyway, I don't want to go into all the details. Kramer say, oh, buy. This is great. And here's the thing. I'd come into the office the next morning and I'd see what there are 4 analysts who are really kind of the axe on Salesforce. And I'd come in and I'd think, okay, great, man, they're going to take down their numbers. They're going to kill it. It's going to be fantastic. And just the opposite would happen. I'd read it and I'd say, wait, what the hell? I mean, they're saying the same things. Oh yeah, on a pro forma net revenue growth number, they killed this quarter. This was great. And then I just slap my head and say, shit, I'm going to get my teeth kicked in again, right? Again. And so what I learned was I'm not going to be short Salesforce going into the quarter because Mark Benioff, tip your cap to the man, right? He figured out that the way to create an effective story was to focus on, again, net revenue sales growth, not old-fashioned metrics like, profits or operating income or anything like that. No. I'm going to create the metric. I'm going to convince a core group of analysts that this is the metric they should be following. I'm going to have my megaphone be Kramer and Mad Money, and I'm going to be, $10 billion richer as a result of this. So what I would do is I'd short Salesforce for every other day of the year, but not that one day of going into earnings. So my question to you with your stock, Dan, is how good is the CEO at creating a narrative around the stock so that no matter what the results are, he's created a metric and a story that the analyst can get behind? That would be my question to you. It sounds like if the analyst is saying, oh, I've got my doubts and I'm thinking about taking down numbers, my numbers are too high. And by the way, lots of analysts are saying that over lots of companies right now. Then I don't want to be around. I don't want to be around for that unless I've got a CEO like Mark Benioff who is an absolute master at creating a story and a narrative and keeping the analyst in line. That's what I mean by, that's what succeeds as a CEO today. It ain't operations. It's do you control a narrative?
I think it's interesting. One thing, I think what's being missed is the transmission mechanism. Why is it that it's contrarian if Kramer or somebody on, a popular financial media program is talking about stock? Well, they're doing that because their own analytics are showing that a lot of people are searching for that stock, right? And so it's basically it's a kind of a form of clickbait, right? It's how do you get bigger ratings? You talk about what people are looking for. So that alone tells you that if everyone's looking for it to the point where it causes them to bring it up on TV because they want the audience, that you're probably towards the end of some kind of move that's already happened.
Yeah, that's exactly right. But I want to talk about the second leg of what John was asking. Doesn't it make sense to be long or short, right? I mean, if that's your long-term view of a company, right? And this is going to tie back to our first set of questions. Can you keep other people's money for that long-term view? I am all for having a long-term view. Because you really know it's the real world operations of the company. You have an opinion, you have a view, and by God, you have the guts to put that money where your mouth is, and you're going to stick with it. My question is around the stick with it part. Can you stick with it? Can you stick with it? Because the path will matter to your outside investors. It just does. As much as we want to say, oh, no. And everyone who's been on this call so far has experienced this, where you've got an investor and they say, no, we're with you for the long haul. And then something will happen in their business or the like, and, you get the redemption notice. So I am in total agreement, John, with both the first leg of what you said. You want to fade the micro narratives, because they are, as you're describing, it's a reaction to, this is their business to create an explanation for something that happened in the world. And it maybe is right, maybe is wrong, but there's nothing necessarily right about what they're saying. So you want to fade it. But I'm also in very much agreement with the second leg of what you're saying, the long leg of this. And the question you've got to ask yourself there is the money going to stick with me? Right? What is it my money? Can I stick with it? That's great if you can. You got to understand the duration of the risk you're taking versus the duration of your funding. And that's a question that most, at least early on, asset managers don't ask themselves. But in my experience, and I bet in the experience of a lot of people here, it's the most important question for the business of asset management. Is the duration of the risk I'm taking equal to the duration of the money that I've got in? So that's my answer there.
Which again almost also relates a little bit to that earlier point we mentioned before,
exactly.
Which is the line between is a sunk cost fallacy or selling below. And I'll use the two lines I often use on the road, which relate directly to what you just said. One is your ability to stick to a strategy matters more than the strategy itself, which means that at the end of the day, you can look at any chart all you want, but the reality is if you're not going to actually stick to it, it doesn't matter, right? It's worth the investment thesis. And then to your point, path matters more than prediction, which is always wild to me because the reality is for most people, you shouldn't care about the path if you're an investor. You care about the endpoint, but people will respond off of the path to the endpoint. And that's the great challenge. You can't control that. That goes back to the epsilon. That's the error.
Yeah. So let me use another example. Famous person, Kathy freaking Wood. Right? ARK is still getting inflows. It's still getting inflows. I know it does, but here's the reason why it's still getting inflows. Because she, like Benioff, like God help us Donald Trump, they're really good at creating that story, that narrative. Kathy Wood, and this gets back to your point about do you change your stripes as an investor, right? My point is, what I'm thinking, I want to think about that in narrative terms. It's important as an investor, as a portfolio manager, you not change your stripes in terms of your investment style. It's even more important as a portfolio manager that you not change your stripes in terms of the story, the narrative. Kathy has been, from the word go, she's had this consistent story. She tells it extremely well. Whatever you think of the story, I think the story is crap, but she tells it extremely well, and that is the secret of her success. During earnings season, you often get a lot of micro, I'll call it noise in there. But I'll say this, Jeremy, even on the macro stuff, this is something we're seeing in our work right now. The life cycle, the duration of a consistent macro narrative signal, it's just all over the place right now, man. It is all over the place. I was talking with Michael kind of about how to describe give a title or catch a phrase. And I said, it's like we're in kind of narrative tachycardia right now. What I mean by that is there is no good rhythm in narrative world right now where I could say, oh yeah, you want to do this, or you want to do that. We're seeing our measurements change from week to week when typically they change from month to month. So it's in narrative world as in real world, as in market world, people really don't know what's next. People really don't know what's next. So I'm gonna beg off from giving any sort of, advice on any sectors right now, except to say, it's like our heart is fibrillating and we need a defibrillation. We need a defibrillator to give ourselves an electric shock. The problem is those shocks usually come in the form of a war, a recession, some sort of event like that. So I wish I could be more helpful, but in narrative world, we're just seeing the narrative heart just beating wildly without any good rhythm right now.
And closing it off, I think it kind of makes sense that that's the case, right? Because narrative follows price, and price doesn't know what the hell to do in any asset class in this environment, which is largely unprecedented. So with that said, everybody that's been here for the hour, again, please make sure you follow Ben Hunt. Appreciate your time.